Okay, that sums up the week that went by. Let's also give you a quick update in terms of what the numbers look like. And that cut of a 0.25% that we've seen coming in on the Nifty was largely a consequence of the 2% fall that we saw on Tuesday. One might have wondered that that cover up has happened over the course of the week, but nonetheless, it's been a very minute cut of about 0.25% for the Nifty for the week gone by. But with this move on the Nifty has snapped its 4-week gaining streak, because no matter how nominally we've ended the week in the red for the Nifty, but we've at least managed to hold on to that 24,200 mark for the Nifty 50 on the spot. On the flip side, you had Nifty Bank that was slightly more resilient, flat move, but at least in the green with an uptick of about 0.2%. The sectoral move was rather mixed, no exaggerated moves barring Nifty Realty. A very strong update from Phoenix Mills. A bunch of other stocks were in focus, and Nifty Realty was the top sectoral gainer with an uptick of 5% in the week gone by, followed by some very good moves coming in Nifty IT. TCS earnings were in focus as well. A 2% uptick on Nifty IT, followed by 7/10 on the metal index, 6/10 on the PSU banks. Remember, this week was a heavy one in terms of PSU and private bank updates. Speaking of updates, you had a bloodbath on Trent when its update came out, weaker than what the street was penciling in, a 13% fall on that stock for the day as well as for the rest of the week. And Nifty Bank was absolutely flat. It was FMCG that was flat with a hint of red. Nifty Pharma's closed the week lower by 0.3, and even the most losing sector, that was Nifty Auto, has also shut shop with cuts of only 0.5%. So that is the tilt of the market. Not a lot of weakness, but yes, individual stocks were in focus on the back of either earnings or updates, and that has largely been the way the market has panned out in the week gone by. Some big movers have been Paytm, Cochin Shipyard in the red, Trent, DMart. These were some of the stocks that were in focus. A bunch of defense stocks also had their fair share of momentum that we've seen in the market. So all in all, that sums up the kind of market that we've seen. But while that's everything about the week gone by, what should you be watching out for the next week of trade to come in terms of some factors, earnings, as well as some corporate action, both globally and back home? Let's bring on board Meryl with a list of all of those details.
Coming to you with some of the important domestic and global developments that could shape the markets in the coming week. Starting first with India, we've got the India trade and CPI data to watch out for. CPI data will also be in focus from the US and Chinese markets, where in the US markets we'll also be tracking the Fed budget balance, the PPI data, as well as Fed beige book, which will also be releasing. And from the China markets, we've got trade data as well as GDP data in focus in the upcoming week. Well, it's a big week for Nifty earnings back home. We've got HCL Tech, HDFC Life, Tech Mahindra, Wipro and JSW Steel. All of these names are set to report their quarterly results. And in terms of primary markets as well, it's quite a busy week. We've got Laser Power and Infra's IPO, which is set to close on the exchanges, while Alpine Tech's World and SBI Fund Management IPOs are set to open as well. In terms of lock-in periods ending also, we've got Bharat Coking Coal, where a whopping 70% of its equity share capital comes out of a lock-in period. So do watch out for selling pressure on that name. In terms of global events and other events to track, we've got PM Modi set to continue his New Zealand visit, OPEC about to release its monthly oil market report, EU foreign ministers who are set to meet in Brussels, and we've also got Fed Chair Kevin Warsh's testimony to track as well. So yes, these were some of the important cues that you should watch out for in the upcoming week.
Thanks, Meryl, for that update. So it's a packed next week. We have there are a couple of Nifty earnings also coming in there. But now joining us is Gurmeet Challa, who is the managing partner of Complete Circle. Gurmeet, hi. Good evening. The way we have seen the IT come back today, do you see that the markets have the IT sector or IT stocks have now bottomed out, and it's all about how they're going to what kind of commentary they're going to get, or what kind of growth they're looking at?
So I think if you see TCS commentary, I think one thing which clearly stood out was the net headcount addition of more than 9,000 employees. This happened after 3-4 quarters of negative headcount. Also, if you adjust the one-off which they had to incur, which was I think 660 odd crores, the numbers were actually slightly better. The revenues were slightly better. Also, I think what I liked was the breakup they gave on the AI vertical, now almost doing 2.6 billion The deal TCV was good, and the fact that it has corrected so much, and I think last 5 year returns are negative for TCS. I think Infosys would be fairly similar. So there is valuation comfort with these stocks trading at 12, 14 times, and there could be a tactical bounce. But now, whether that is structural would depend on how the rest of the pack also fares. I look forward to what Infi does and HCL does and Tech Mahindra does, and then probably we'll have a better view on it. But if, let's say, the numbers are what TCS have shown, you could have maybe a tactical bounce. But for it to be structural, I think we need to come back to at least mid single digit constant currency growth, heavy deal wins. But there is now some sense getting in that the token capital and AI costs now may not is actually inching up, and you would probably need more integration with human capital to fully utilize the AI potential. So I think tactically maybe yes for now. Whether it is structural, I think we probably have to wait for some more time.
Gurmeet, so within the IT basket, are you bullish on the large caps or the mid caps?
So we have very small exposure. So we are not completely out of IT services. We have HCL Tech, which relatively has done well. They announced a large deal last week, and it's been I mean, it's fallen less. Let me put it this way, rather than saying it's a relative outperformer. Also, it is more diversified. So you have IT services. They have a software business which almost does now 20% of the EBITDA. Then there is ERD vertical. Actually, we have added a little bit to KPIT post the heavy correction it has seen, but that's more. So between the two, we would probably have less than 3% exposure as far as our portfolios go. But we are looking at persistent post the sharp fall there. We are evaluating some more mid-cap IT names. We are evaluating Intellect Design. So it's very stock specific as the valuations have significantly corrected. And I think the smaller companies have a better chance to pivot and take advantage of this. So for now, very small exposure, but I mean, given an opportunity, we may look at adding more.
Okay, so that's your take on IT. Gurmeet, hi, this is Nehi also joining in. Other than IT, the other big talking point for the week was the financials, because you had updates coming in from both private and public sector banks in the last few days. How have you read through those updates? And if you had to make a choice between the PSUs or private sectors when it comes to banking, where would the tilt be?
I think the updates have been very strong, and I think that's why I think the market was expecting a very subdued Q1. The bank updates, some of the FMCG companies like Dabur, Imami, etc. We had a very good update from Titan. So some of the consumer companies also have given good updates. So the Q1 may not be as bad as the street was fearing, and I think banks may lead. In terms of the earnings. I think the update from SDFC was pretty good after a very long time. Finally seeing 15-16% advance growth, which has been missing for a while now, and the market has slightly responded to it. I think still more ground needs to be covered. We are now looking at banks which are likely to get a higher share of FCNR deposit, FCNRB deposits, especially banks with overseas branches in Middle East, Singapore, and a private and a lending arrangement, because there's a lot of leverage which will come through the FCNRB. So ICICI has good presence in Middle East, Singapore, London, etc. Federal Bank, being South-based more, has a very good presence. And then you have SDFC. So we are more looking at banks where we are likely to get with a higher NR base, likely to get better FCNRB. And we are also looking at some of the capital marketplace as broader sentiment improves in financials. We have added Grow, we have added a couple of asset management companies, and we are also looking at some of the vehicle finance, especially with the uptick in the CV cycle. So overall, we are pretty overweight here and have quite a few names in our portfolio.
How do you look at the fact that with all the updates that we saw from the financials, the lending growth has been more than the deposit growth? And that also brings in some worry, because over the next few quarters, you will have that issue coming in back for the banking system.
No, it will be, and I think we have to now get used to it that CASA advantage for banks with growing awareness on capital markets would be hard to come by, and that's why banks with better liability mix stand to gain. And look at SBI, for example, they have like 21 lakh crores in CASA, which is current and saving account, which is almost 40% of the liability book. Now that's a big advantage, and more FCNR deposit also means on these deposits you don't have to do provisioning of CRR and SLR etc., which means better lower cost of fund and maybe a NIM improvement of 3, 4, 5 basis points. Uh, all banks with better CASA, I think, will stand to gain as deposit mobilization becomes tough and market relies more on borrowings and bulk deposits, etc. So that's why I said I think we have, for example, HDFC, ICICI, and Federal in our portfolio. We added RBL post, once the UAE Emirates took the majority stake there. So these are the 4 banks we hold, and we have some exposure to SBI. I think there'll be a little bit some value unlocking also with SBI Mutual Fund IPO coming next week. I think it's going to be quite a good IPO in my expectation. Very profitable franchise for SBI. We are looking at some more opportunities if we get something in some of the tier 2 banks. I've not seen credit growth at 17, 18%, and at least in last 10, 12 years. So I think this is very, very good signs for the economy also.
I was about to ask you about SBI Mutual Fund, and you spoke about it. How do you look at that IPO?
Very constructive on it. I think it's the largest asset manager, 12 lakh crores almost of equity AUM, 3,500, 4,000 crore kind of a PAT. And I think very reasonably valued vis-a-vis some of the private, and I think, their distribution reach is unparalleled. And I think it should do very well. And I think it's a very asset light business. I mean, which business you can make 4,000 crore PAT with 100 crore authorized capital? I think it's an infinite ROE business. And I think the mutual fund industry today crossed 76 lakh crores of AUM, which is more than the FPI holding in India, which is 75 lakh crores. So I think it itself tells you how structural this financialization of savings is. So I think SBI being the leader will tend to gain. So I think it will be a very steady compounder.
In fact, looking good on that front, Gurmeet, and it's good to know that you are also very constructive on this IPO. So we're going to be looking forward to this in the week to come as well. But rewinding a little bit, and let's also once again revisit a sector where we've seen lots of updates coming in, and that's consumption, both on the core FMCG front, and then you've seen some retail as well as value retail numbers also come out. Of course, the biggest casualty from that entire basket was Trent and that sharp 13% fall that we've seen for the stock in the week gone by. Are you constructive on consumption at all? Could it be pockets, or what's the view on the sector overall?
So there are 2 ways we are playing the consumption story.
Okay.
One is through auto, which I both two-wheeler, four-wheeler, and ancillaries. I think auto sector was beaten down because of crude prices going up, and then there were fears of monsoon. I think both of them to some extent have been addressed. Crude is back at about $75, $77, and monsoon has advanced pretty well, especially in western and northern parts of the country. So I think the stocks have corrected quite a bit. Even some of the larger names like M&M are still probably 20% down. So I think auto looks very good. Also with the EV adoption picking up, I think in two-wheelers, it's picking up very fast. Even in four-wheelers, if you see last month, it's 11% EV mix now, which means that some of the auto ancillaries, which are giving you an EV play, also will probably give you a better delta. So we have Uno Minda in our portfolio. We have Sandhar Technologies. We've recently added Motherson Wiring, and we have some of the quasi plays like, for example, Rajratan, which makes bead wires for tires. So we are pretty constructive here. The other way is to have some of the platform plays as consumption picks up. So we have Eternal in the portfolio. We are looking to add, we have added a little bit in Misho, and we are looking at more, names there. We are looking at some of the food companies also because the prices have gone up, especially coffee prices. So we have Tata Consumer in our portfolio. So we're playing it through a mixed basket. And I think post GST cut, the sector got a little subdued. And I think if geopolitical tensions ease, supply chain ease, and raw material inflation comes down, I think consumption may do well.
In fact, Gurmeet, earlier in the day, we were chatting with someone, and he said that the way he would like to play consumption is not via consumption at all, is via NBFCs, because the demand for credit is going to go up. I mean, that was his view, of course, but that was a very interesting view. How are you looking at NBFCs? We've spoken about PSUs and private banks, but what's your take on NBFCs?
So as I said, we are looking at adding some of the CV financiers in the portfolio because the CV cycle has had a very good uptake. We are also we anyways have Bajaj Finance in the portfolio. Another pocket which I like structurally is housing finance. I think there's a government support and especially affordable housing. It's a very difficult business, and once you get into it, there is a very invisible entry barrier which comes in. So we have Home First. We've recently added Bajaj Housing Finance. I mean, post IPO, it had a bumper listing, went up to maybe 190, I think, and then all is in two digits. So those are the space we are doing, and we have Muthoot, which is the gold NBFC. So we're covering that. As I said, banks, NBFCs, and capital market plays. That's how our entire BFSI portfolio looks like.
So within the housing finance, how are you looking at other companies?
So we have Home First and Bajaj Housing Finance in the portfolio. We are evaluating some of the other names, including, for example, LIC and PNB for valuation comfort. But I mean, you can own as many, right? I mean, if you run a 25-30 stock portfolio, some things you have to leave out. So for now, we are good with Bajaj Housing. I think the quarterly update was also pretty decent. And I think you will see more government measures, especially related to the agrarian sector, which will further give boost to affordable housing. So, and this is one pocket which doesn't get disrupted by AI or slowdown in IT, etc. Which is so that what gets disrupted is mid end and mid luxury segment. Affordable housing continues to see strong disbursements as well as strong demand.
Gurmeet, one stock which was punished very badly was Trent. A few percentage point decline in top line growth, and it was punished hard. How do you look at Trent and the entire retailing space as well?
I mean, it's just that, when you're so richly valued, there is very little room for error. And once you grow at the pace at which Trent has, on that base to expect 30-40% growth is I mean, pretty unreasonable. And I think that's what is happening now. The market will probably have to now price it basis a 20% growth and not 35-40% growth it was used to, considering the base it has. And obviously, there's more competition coming and, etc. So we are neutral right now. Maybe if it falls a little bit more, maybe look at it. I like Varun Beverage actually, which is not really comparable, but it's expanding in categories, it's expanding geographies, it's getting into alcoholic segments, it's done some aggressive acquisitions. So it's creating enablers for future growth. Between carbonated and non-carbonated drinks. So I think that's one space I'm looking at, and we have, as I said, Tata Consumer in the portfolio.
Okay, Gurmeet, you made a point about the street expecting too much in terms of a growth potential on the top line from Trent. Can the same be said about value retail? Because since the time these smaller players have come to the market, V2, V-Mart, the likes, they have been growing consistently at 40, 50, 60%, and the base keeps growing. Yes, for now they've been able to sustain this growth rate, but do you believe in the next couple of years they could have a similar story as Trent?
See, I mean, one thing which this market has taught us that if you're paying a high multiple and earnings don't catch up, I think even a good business, Trent is a great business, right? And so is some of the, let's say, some of the other consumer businesses, whether it is a Lever or a Britannia. But if you overpay and the earnings don't catch up, then you can have extended periods of both price and time correction. And I think that's one learning we've had in last 2 years, 3 years. So wherever the earning growth is not catching up with the valuation multiple, it's best to avoid that space. And that's the reason, as I said, we want to play consumption very differently. See, even the platform plays, some of them are still growing. Quick commerce, see the growth rate in quick commerce. See some of the growth rate and the unit economics of Meesho and maybe something like a Lenskart. I think, and that's a binary play. If you get it wrong there, you badly get it wrong, right? So you have to price in growth with the valuation. That's what we are trying to do.
Gurmeet, at this point, the way the market is, the recent correction that we've seen a bounce back as well. Given the way the things are at this point, which sector or which basket of stocks do you believe is fairly valued and deserves or merits investor interest at this point?
So I think one place which is continuing to get very traction is the AI ancillary place, which is the energy, power equipment, battery storage, transformers, conductors. I think the order books are full. We keep meeting. We met Hitachi. We attended one call. We attended various transcripts with Apar Industries. There's a small company we like, which is in Rectifier, which is into making transformers for largely for railways. So I think the entire power equipment space, whether it is oil gensets, etc., looks very strong. Order books are full. Execution is happening at a good pace, and recently we saw some correction last week. So I think that's one pocket, I think, which will have very good earnings also, and then you can see visibility over next 2 3 years. The second one is defense. I think what is happening in defense is something which happened to EMS, electronic manufacturing, few years back. I think there are two big reforms the government has done, which has got completely unnoticed. Is virtually removing monopoly of HAL over fighter jets and BDM in the missile program. They now have development come production partners, where private players will participate in building missiles and rockets and drones and all the electronic warfare. And I think this could be a big game changer along with localization. And I think Indian defense exports will surprise. And right now they look valuations look high because the base is very low. And I think what we are doing with BrahMos, Pinaka rocket, etc. I think that's one space I'm very bullish for next 5 years. You may have 1 or 2 quarter blip, which is fine. The third one, which I said, banking, very strong update. I think you will be very positively surprised as far as earnings goes. And there are some, small pockets also, like for example, chemicals. Yuan has appreciated more than 20% against the rupee. Chinese have removed some of the export rebates so that the bit of import substitution happening there. And a lot of chemical names have been beaten down. So that's another pocket we are selectively looking at.
Uh, you mentioned defense there, but we've seen some consolidation also happening in defense, especially in the energetic space, where Astra Micro is acquiring Premier Explosive, and that's the second acquisition for them. How are you looking at that consolidation? Are you looking at more such events happening between the private sector space?
It will happen because it needs a lot of technology collaboration and a lot of capital. So it's very important that you look at the balance sheet strength now. Order books, I think a lot of players have plenty. I think now what would come is execution risk. And that's the reason delivery is now important. So with order books, the stocks have run up, but if the delivery doesn't come, because this business can have long gestation periods. So we are looking at shorter execution cycles. Players where you'll have regular, cash flows also coming. So, for example, solar industries, a great multi-bagger for us, has a nice mix of explosives and defense. Defense is only 30%, and they're already guiding for 4,000 crores. But they have new projects like Kusha, which is a missile program. There is MAIL, which is medium altitude drone. Then you have Bhargavastra, which is the anti-drone system. So there are more verticals which can expect the good. And then you had the Pinaka testing day before yesterday of the extended range. Bharat Electronics is looking good, 75-80,000 crore. And, as I said, faster execution cycle. We are looking at some of the niche names like data pattern also. So you have to break the value chain. And we are focused more towards missiles, rockets, drones, and anti-drone systems versus, let's say, ships and it's not that we don't like that space. It's just that the stocks are already up on news of the order. The execution and gestation can take longer.
One space is the consumption one, a monsoon and El Nino impact. How do you look at the staples at this point in time?
No, we are not very, we hardly have any staple stock. One we have is Tata Consumer, which is not really a staple company because food prices are up, coffee prices, for example, are up 12-14%. And there was some disruption because of the Iran conflict. So that's only we like. We are evaluating, as I said, Varun Beverages. That's another name we like. It's done a lot of capex, and I think it's creating more verticals for future growth. Other than that, we have nothing in the portfolio.
QSR pack as well, Jubilant.
No, so we have Eternal in the portfolio, which is quick commerce and food delivery, and we have Misho, if you want to call it a consumption, yes, but it's largely a zero discount, more focused on tier 2, tier 3 sides. So these two names we have.
Gurmeet, I'm wondering how are you looking at the pharma space? Asking you because we've seen a very massive cut on Dr. Reddy's also in the week gone by. There's been negative news. Do you believe the entire hype around CDMO, semaglutide has lived its run, or do you believe that there is more legroom for growth over there?
It's a very good question, actually. So, I think the valuations have gone up clearly. Just see the way a Loris or a Newland Lab or Shilpa or some of the other names have gone up. So you have to be very clear in terms of, what is the pipeline of molecules, how many molecules are in stage 3, stage 4, what will get commercialized, the size of the opportunity, because, it is a lumpy business. For example, in the entire bull run from 21 to 23, Loris did not participate. It was actually down. Newland has seen 70% price correction from 3,000 to, I think I remember correctly, maybe $900, $1,000. So it is a lumpy business. And if you're coming in putting incremental money here, you have to have a longer haul and be very sure that the new molecule pipeline will see it over the next 3, 4 years. And there's obviously some element of risk there. So I think it's to me, I think a lot of the good news is in the price. But let's say if US was to pass the Biosecure Act, which actually bans almost 5 Chinese companies, especially related to genome data and genetic mapping. I think this could open up more opportunities for India. So I think it's something you have to be a little careful about in terms of incremental addition.
Sector of the week, realty, real estate.
No, you see, it's not homogeneous. So, for example, NCR, I think prices are too high because I stay here. Uh, you know, even a Noida or some of the places are now 20, 21, 22,000, 26,000 rupees square feet launches. I mean, you can't make too much money. There's a bit of a tapering of the demand, especially at the mid luxury end. But for example, in Mumbai, in selective builders, and in Bangalore, it's still pretty good. So we are avoiding this space. I honestly don't understand this reality business much, and I'm better off playing it through the lenders and the housing finance guys.
And also some ancillary sectors like how would you be looking at a cement? We've spoken about that. Cement is there. You've got tiles, furnishing. There is so much that is at the ancillary play. Wires and cables, for example, that's a big one.
No, so wires and cables. I mean, the building material we are quite constructive. So Polycab we're holding since IPO, and I think there are. I mean that's one pocket which is going. Just see the capex happening, both in terms of grid as well as the data center play and in general the housing demand. Multiple levers at play, and they're gaining market share. They've done pretty well. I think they are also pivoting to optical fiber, etc. So that's something we like. Other than that, we do not have a cement or a steel play. We are looking at some of the aluminum plays because the prices are very firm. It's still at about $3,200 odd dollars, and energy prices have come down, which means the cost of production is down to 1,700, 1,800. And for example, Vedanta is I think 3 million tons, if I'm not wrong. And the other two, so I think Hindalco has I think 1.5 and Nalco 0.5. So others' capacity will take time. Vedanta has that capacity. So maybe Vedanta Aluminium can tactically do well. But other than that, hardly any ferrous, non-ferrous plays in the portfolio.
Gurmeet, as always, it's been a pleasure having you. Thank you for your time and thank you for such a deep dive on your views. Lovely as always to chat with you. Thank you so much.
Thank you so much.